Think about the most financially responsible person you know. Maybe it's a parent, a colleague, maybe it's you. They work consistently. They don't overspend on obvious things. They put money aside every month without fail. And yet, years pass and something doesn't quite add up. The number in the account grows slowly. Life gets slightly more expensive. The gap between where they are and where they expect it to be never quite closes. That's not a story about bad luck. It's not a story about low income. It's a story about a financial belief that most people inherit without ever questioning it. The belief that saving money is, by itself, a strategy for building wealth. It isn't. And today, we're going to walk through exactly why. This isn't a video about spending less. You probably already spend carefully. This is about what happens after the money is saved, the part of the conversation that banks, schools, and most financial advice conveniently skips, because saving money and growing money are two completely different activities, and confusing one for the other is one of the most common and most costly financial mistakes a person can make. Let's talk about Sarah. She's 31, she works as a project coordinator at a mid-sized company in Boston, or in Amsterdam if you're watching from Europe. The geography doesn't matter much. The numbers tell the same story in most Western cities. Sarah earns $62,000 a year. After federal and state taxes, Social Security, and health insurance contributions, she takes home approximately $3,950 a month. She's careful with money. She tracks her spending. She doesn't live recklessly. By most conventional measures, she's doing the right things. Here's what her month actually looks like. Monthly take-home, $3,950. Rent, one-bed apartment, minus $1,450. Car payment plus insurance, minus $440. Student loan repayment, minus $310. Groceries and household, minus $340. Utilities, phone, and internet, minus $140. Subscriptions and transport, minus $95. Social spending and personal, minus $215. Saved each month, $960. $960 a month. That's not a small amount. That represents genuine discipline, real choices, real trade-offs. Sarah is doing what she was told to do, and she feels good about it. Over 1 year, she saves $11,520. Over 5 years, with a standard high-yield savings account returning around 4% annually, she accumulates approximately $63,500. That's a meaningful number. She worked for it. She earned it through consistent, deliberate choices. But there's a calculation Sarah isn't running, and it's the one that matters most. Inflation is not an abstract economic concept. It is a direct, ongoing tax on money that sits still. In the United States, inflation has averaged between 3 and 4% over the past 30 years. In the Eurozone, the figure has been similar, with significant spikes in recent years pushing the cumulative damage even higher. What this means in practice, if Sarah's savings account earns 4% and inflation runs at 3.5%, her real return, the actual increase in what her money can buy, is approximately 0.5% per year. She's not growing her wealth, she's maintaining it, barely, at enormous psychological cost. Let's make this concrete. Saved over 5 years, $57,600. Principal, savings account interest, 4%, plus $6,200 estimate. Inflation erosion, 3.5% per year, minus $9,800 estimate. Real purchasing power gain, approximately minus $3,600. After 5 years of disciplined saving, Sarah's real financial position has improved by almost nothing. In terms of what her money can actually buy, groceries, rent, a car, a home, she's slightly behind where she started. Not because she made bad decisions, because she made incomplete ones. Now extend that out. Over 20 years, the same pattern compounds. The gap between what she saved and what she could have built doesn't stay flat, it widens year by year, quietly and invisibly. 20-year projection, $960 a month. Savings account at 4%, approximately $352,000. Purchasing power, inflation adjusted, approximately $193,000. Broad index fund at 8% average, approximately $572,000. Opportunity cost over 20 years, approximately $220,000. It's worth being clear about something here. This is not Sarah's fault. The financial education most people receive in school, from parents, from mainstream media, stops at saving. Open an account, put money in it, watch the number go up. That's the full lesson. What's never explained is that a savings account is a tool designed to protect money from immediate loss, not to grow it. Banks offer savings accounts because your deposits are their cheapest source of lending capital. When you park $63,000 in a savings account earning 4%, your bank is lending that money out at 7%, 9%, 12% on mortgages, business loans, credit cards. The spread between what they pay you and what they charge others is their profit, and it comes in part from your inaction. So if the math is this straightforward, why do so many people with good incomes and genuine discipline end up in Sarah's position? The answer is psychological, not financial. Behavioral economics describes something called completion bias, the tendency for the brain to register an action as finished once a visible task is completed. Sarah transferred money to savings. She moved it. She did something. The brain marks that as done and moves on. The deeper question, what should this money be doing next, never gets asked because the brain has already filed the task under resolved. This is not a character flaw. It's a cognitive pattern that affects most people across all income levels. The action of saving is visible. The inaction of leaving money idle is invisible, and we are not well equipped psychologically to respond to invisible problems. There's a second psychological mechanism at work, and it's possibly even more powerful. Loss aversion, a concept from Daniel Kahneman's work in behavioral economics, describes the finding that the psychological pain of losing a sum of money is roughly twice the intensity of the pleasure of gaining the same amount. When Sarah considers moving her savings into investments, her mind doesn't run a rational expected value calculation. It imagines the worst case. The market drops, the number goes down. That imagined loss, even a temporary paper one, creates real psychological discomfort, and so she leaves the money where it is. Not because she's irrational, because she's human, and the financial system she inherited never gave her the context to reason past that discomfort. Add to this what psychologists call status quo bias, the preference for the current state of affairs simply because it's familiar. The savings account exists, it has a number. That number goes up slightly each month. Changing that arrangement requires mental effort, research, and a tolerance for uncertainty that most people haven't been trained to develop, so the default persists, and the default in this case costs money. People who build wealth over time, not through inheritance, not through extraordinary income, but through consistent financial behavior, tend to think about money in terms of what it's doing, not just how much of it exists. They don't think of saving and investing as two separate sequential steps. They treat saving as a brief transit point. Money arrives, a small portion stays liquid, 3 to 6 months of expenses accessible in case of emergency. Everything beyond that threshold is deployed, not gambled, not speculated, deployed into assets that compound over time with reasonable, historically supported returns. For most people in the United States and Europe, these are low-cost index funds tracking broad market indices. The S&P 500 has averaged approximately 10% annually over the past century, or around 7% after inflation. European equivalents tell a similar story over similar timeframes. These aren't exotic instruments. They're the most boring, widely accessible financial tools available, and they are where long-term real wealth accumulates. Return to Sarah. Same income, same expenses, same $960 saved every month. The only change, after maintaining a $15,000 emergency fund in her savings account, the remainder goes into a broad market index fund. Same discipline, different destination. Emergency fund, savings account, $15,000, stays liquid. $960 a month into index fund, 8% average. After 10 years, approximately $175,000. After 20 years, approximately $572,000. Versus savings account, 20 years, inflation adjusted, approximately $193,000. The difference between these two outcomes is not income, it's not intelligence, it's not access to special information. It's a single structural decision made once, adjusted occasionally, and then left to compound.
That's the actual behavior of people who end up in materially different financial positions over time. Not hustle, not sacrifice, a quiet redirection of money that was already being saved. The point of this video isn't to make saving sound wrong. Saving is necessary. Without it, none of the rest is possible. The point is that saving is a first step, not a complete strategy. And for most people, it's been presented as a complete strategy. That gap between what they were told and what's actually true is where years of potential growth quietly disappear. You don't need to change everything tomorrow. You don't need to become an expert in markets or economics. What you need, and what most people are genuinely never given, is an accurate picture of what your money is doing and what it could be doing instead. That picture, once clear, tends to make the next step fairly obvious. If this gave you a clearer way of thinking about money, not a shortcut, just clarity, then this channel is worth subscribing to. There's more of this kind of thinking here. No urgency, no shortcuts, just a more honest and rational
about how you spend, share it with someone who needs to hear it. And subscribe to Alpha Money Pro, because next week we're going even deeper into the psychology that keeps most people financially stuck. See you then.